Hello everybody. Today I'm going to review chapter 3, which is about adjusting accounts and preparing financial statements. So adjusting accounts is mainly part of the accounting cycle. Okay, so remember in chapter 2 we analyzing and recording the transaction. So we started with analyzing each transaction and event from source document. Okay, and then record this transaction in a general journal. And then once we record the transaction in the general journal, we mainly post them to the ledger accounts. And from the ledger accounts, we prepare what is called trial balance. After preparing trial balance, we start to look at adjusting accounts and preparing financial statements. So adjusting accounts is mainly related to specific accounting principles. So this is mainly we need to compare here between cash basis and accrual basis. So in cash basis, revenue are recognized when cash is received and expenses are recorded when cash is paid. So this means when we receive cash or when we pay cash, at this point we record the revenue and expenses. This is mainly called cash basis. So this is not acceptable in accounting. So this is mainly called non-GAAP, so which is not the normal basis that we use in accounting. So we normally use in accounting accrual basis. And accrual basis here, revenue are recognized when earned and expenses are recognized when incurred. So earned means that when the revenue is mainly when the goods are delivered to the customer. So at this point of time, which is mainly when the exchange happened, so in this case the revenue is mainly recognized, and at the same point expenses are recognized when it is incurred, which means that when the service is mainly received by the company, so in this case the expenses should be recognized. And this is mainly related to the accounting period. So whether we recognize the revenue in the period in which goods or service are delivered or rendered, or at the point at which the revenue and expenses are paid. Okay, so here is example to clarify this point about cash basis and accrual basis. So for example, fast food paid 2,400 for 24 months insurance policy beginning December 1st, 2005. So if the company is following a cash basis, so in this case, the entire amount, which is 2,400, will be recognized at the point of payment, which is mainly when the company pays the insurance. So at this point, which is mainly the 1st of December, so the insurance is recognized as insurance expense. So it is mainly related to only one period, which is 2005, and no other period will be affected by the insurance expense if the company use mainly cash basis. Okay, so despite the fact that the insurance policy cover 24 months, which is mainly 2 years, so it will only affect the first year, which is mainly the year in which the company paid the insurance. So this is mainly against the reality. So in this case, if we follow the alternative basis, which is accrual basis, so in this case, the first year, which is mainly 2015, will be affected by only 1 month's insurance expense, so which is 100, and the other years will also be affected by the insurance expense. So second year, which is mainly 2016, the insurance expense will be the company will benefit from the insurance in 2016. This means the whole year, and for 2017 also the company will benefit from the insurance cover in this year as well for 11 months. So accrual basis mainly allocate the insurance based on the use. Okay, so the company will benefit from the insurance for 3 years, in 2015 1 month, in 2016 12 months, and in 2017 mainly 11 months. And this means again about the point of at which the company should recognize the revenue, which is mainly here at the point of delivery. So revenue is mainly earned when the customer receive the goods or the service is mainly rendered to the customer. So in this case, the revenue should be recognized not at the point of receiving the cash from the customer. Okay. At the same time, when we look at the expenses, so the expense here we follow another principle which is mainly called matching principle. So expenses is mainly incurred. So when the company receives the service as well from employees, from utilities, like when the company gets the service about gas, electricity. So in this case, so the expenses is mainly incurred. Okay, so we have, because of these differences between cash basis and accrual basis, so we have some cases in which we need to make some adjustment. Okay, so we in this case we mainly doing adjusting entries, and this adjusting entry is mainly at the end of the accounting period. We have in total 4 different types of adjustment. So the first one, we have 2 main categories. The first category about when the cash paid or received before expense or revenue recognized. So we have 2 cases here. So we have prepaid or deferred expenses, this mainly including depreciation. We have also unearned or deferred revenue. And the other category, when the cash is mainly paid or received after expense or revenue recognized. So we have accrued expense and accrued revenue. So starting with the first type, which is prepaid or deferred expenses. So in this case, so the company here resources paid for prior to receiving the actual benefits. So like, for example, insurance. Okay, so in this case, this is mainly example. So if we see this example, on October 1st, 2015, fast food paid 2,400 for insurance for 2 years, which is mainly 24 months. So 24 months will benefit from the insurance starting from December 2015, and this mainly through November 2017. This mainly 24 months. Fast food recorded the expenditure as prepaid expenses on December 31st, 2015. So in this, at this date, so when the company paid the insurance, which mainly on December the 1st, so the entry that the company do is mainly debit prepaid insurance, which is mainly recognized as assets. So because it has future benefits, with the amount of 2,400, and the credit side is cash. Okay, at the end of the year, which is mainly December 31st, 2015, so the company use or benefit from the insurance for only 1 month. So 1 month, which is the first month, is equivalent to 100, because 2,400 is mainly for 24 months over 24 months. So this will give us 100 per month. So we will have adjusting entry, and in the adjusting entry we have the debit side is insurance expense, and the credit side is prepaid insurance, which means that the part that the company used from the insurance will be recognized as insurance expense, and we reduce the benefits, the future benefits, which is mainly the prepaid insurance, with the 100, which is the amount that the company, which is this amount that is expired from the insurance. So you'll see here in the prepaid insurance, we have 2,400 debit and 100 credit based on this adjusting entry. So, and then the remaining balance, which is 2,300, this will be used in future years. And for insurance expense, we have in the debit side 100. Another item that is mainly under this category about prepaid expenses. So we have supplies, okay, and the supplies also has similar treatment to the prepaid insurance. So we have during 2015, fast food purchased 9,720 of supplies. So this mainly the purchase. So when the company purchases the supplies, so we have debit side, which is supplies, which is an asset, and the credit side is cash with the amount of 9,720. Okay, so on December 31st, account of the supplies indicate 8,670 on hand. So this mainly is still, this is the remaining items. So we have 1,050 of supplies were used during December. So this is mainly the amount used during the year. So in this case, so when we recorded the supplies, when we purchased them, so we have debit side supplies 9,720 and the credit is cash, okay, or account payable if it is on account. And then at the end of the year, when we do the adjusting entry here, so the debit side will be supplies expense, and the credit is supplies, which is mainly reducing the assets with the amount of supplies that is mainly used, which is 1,050. Okay, you see here from the accounts. So we have in supplies account, we have 9,720. This is mainly the boat, and 1,050 is mainly used in this year. And then the difference is 8,670. This will be used in future periods. And then we have for supplies expense, we have debit with 1,050. We have other type of prepaid expenses, like, for example, prepaid rent, exactly accounted for the same way as insurance and supplies. So we have also a similar type of prepaid expenses, which is mainly depreciation. And the depreciation is mainly for long-term assets like equipment, machines. Okay, so this mainly when the company acquires this type of assets, so the mainly will be used for a longer period. It is not just 1 year, it is more than 1 year. So the company has to allocate the cost of longer-term assets, which is mainly called the blunt assets, over its useful life, which is mainly for how many years the company will use the assets, and this mainly in a systematic and rational way. So the simple methods, there are several methods here to work out the depreciation, but the simple method is mainly called the straight line method. And according to straight line method, so we will work out the depreciation expense using this equation. So we have asset cost minus salvage value. Salvage value here, this is mainly the selling value of the assets at the end of its useful life, and this mainly over the useful life, which is mainly the estimated useful life. So the difference between the cost and salvage value, this is mainly called depreciable value. So this is mainly the value that is mainly subjected to depreciation, and it is divided by the useful life. Example here, so on December 1st, 2015, fast food purchase equipment for 26,000 cash. So this is mainly the equipment. So when the company buys the equipment, so the debit side will be equipment and the credit is cash. Okay, so this is mainly the equipment as the purchase date, and the equipment has estimated useful life of 4 years. So it will be used for 4 years, which is mainly 48 months. And the fast food expect forward expect to sell the equipment at the end of its life for 8,000 cash. So this mainly 8,000 cash, this mainly the salvage value. So in this case, we have the depreciable value is 26 minus 8,000, okay, over 48 months. So this will give us 375 per month. And for the first year, which is 2015, so the assets here, which is mainly the equipment, is mainly used for 1 month, which is mainly December. So in this case, we need to record the depreciation expense for 1 month. So it is debit side is depreciation expense, and credit side is mainly called accumulated depreciation equipment. So, and accumulated depreciation, this is mainly a contra account to the assets account, and the contra account here to the assets account. The assets account is mainly equipment, so this is mainly contra to the equipment account. So this mainly when we present the equipment in the balance sheet or statement of financial position, so we'll exclude the accumulated depreciation from the equipment account. So because we don't need to eliminate the original cost of the equipment. So we have depreciation expense debit with 375 and accumulated depreciation credit with 375. So this is mainly for depreciation, and as I said before here, so when we present the equipment in the balance sheet, so you'll see here equipment 26,000. This is a cost, the original cost, minus accumulated depreciation, which is mainly the depreciation that we just calculated, and the difference here will be the net cost. Which the net cost here, this is mainly known as book value. So this is a book value, which is the difference between the cost minus accumulated depreciation. Okay, so this is mainly the first type of adjustment, which is the prepaid expenses. So starting now to solve some questions on prepaid expenses. So starting here with question number 1. In question number 1, on June 30 of the current calendar year, Apricot paid 8,800 cash for management service to be performed over a 2-year period. Apricot follow a policy of recording all prepaid expenses to assets account at the time of cash payment. And what we need here is adjusting entry on December 31st for Apricot. So if we follow the order of this transaction, so when the company paid the 8,800 cash, so it is mainly recorded as prepaid expenses. So the debit side is mainly recorded as prepaid management service. And the credit side is cash. This is mainly at the time of payment, which is mainly June 30. So this is mainly on June 30. Okay, so this is mainly at the time of payment. And this is mainly, this payment is mainly for an amount which is 8,800, and it's mainly covering 2 years. So this is mainly for 2 years period, which is mainly 24 months. What we need is adjusting entry at the end of the year, and the end of the year is December 31st. Okay, so this means that it is 6 months. So from June 30 to the end of the year, which is December 31st. So this mainly 6 months. So 6 months out of 2 years, which is 24 months. So we have the amount here is 8,800. This mainly paid to cover 2 years, multiplied by 6 months out of 24 months. So this is mainly 2,200. So this amount is mainly of the expenses that the company incurred for this year. So when we record it, it will be debit side, which is management service expenses. This is the amount used from this expenses. And the credit side is reducing the prepaid expense, which is prepaid management service. This is mainly for the amount that we calculated here, which is 2,200. So the question here, the adjusting entry on December 31st for Epcot would include a debit to an expense for 6,600, so this is not correct. A debit to a prepaid expense for 6,600, this is also not correct. A debit to an expense for 2,200, so this is the correct answer here. So this is the debit side. Which is 2,200 debit expense. So the answer here is C. So moving to the second question, it is about also prepaid expenses. So this is mainly covering supplies now. So for the second question, we have here, prior to recording adjusting entries, the office supplies account had a 342 debit balance. A physical count of supplies showed 122 of unused supplies available. So we need to, for adjusting entry, we need to work out the amount of supplies that is mainly used during the year. So when the company purchased the supplies, so the debit side was cash, and the credit, the debit side is office supplies, and the credit is cash, for example. So this mainly when the company purchases the supply. So this is mainly debit. We have office supplies, and the credit is cash when the company purchases these supplies, and this is mainly for the amount which is given here as 342. So this is mainly the initial entry. So what we need is the adjusting entry, which is mainly at the end of the year. So the adjusting entry will be, we need to do the adjusting entry with the amount of supplies that is mainly used. So the used supply, so we need the available supply, which is 342. So this supply is available minus the supplies that is unused and is still available. So this 122. So the amount of supplies that used is merely the difference between the supplies available at the beginning of the year minus the supplies available at the end of the year, and this merely will give us the amount of supplies that is mainly used during the year, which is 342 take away 122. So it's mainly 220, and we will make the adjusting entry with this amount. So the adjusting entry will be supplies expenses, office supplies expenses. This will be debit. And the credit is mainly office supply. and this mainly the debit with 220 and the credit also with 220. So if we check the choices that we have, so the answer here is mainly C. So this mainly C. So we have debit office supplies expense 220 and the credit office supplies with the amount of 220. So the answer here is C. Moving now to question 3. And the question 3 also about the prepaid expenses. So in question 3, we have on April 1st, a company paid 2,214 premium on a 3-year insurance policy with benefits beginning on that date. What will be the insurance expense on the annual income statement for the year ended December 31st? So which means that we need to work out the amount of insurance used in the first year. So we have the amount of the insurance that is mainly paid. It is 2,214, and this mainly covering 3 years, which is mainly 36 months. And the company here benefit from the first year, benefit from the insurance from April 1st to 31st December. So which means that it is mainly around 9 months, which is April, then May, June, July, August, September, October, November, and December. So this is nearly 9 months, 9 months out of 36 months. So this means the amount of insurance expired or used. So this is mainly 553.5. So this means the amount of insurance expired which is mainly the insurance expense. And this is mainly for the first year. So, and the answer here is D. So the answer is D. Moving to question 4. On April 1st, a company purchased a 5-year insurance policy for 2,050 with coverage starting immediately. If the purchase was recorded in the prepaid insurance account and the company record adjustment only at year end, the adjusting entry at the end of the first year is. So we need the adjusting entry at the end for the first year, and the company here may use the insurance here for 5 years. Okay, so this is 2,050. This is mainly covering 5 years. So the insurance for 1 year for first year, year 1. So we have 2,050. This is mainly covering 5 years. So it's mainly 410, and then we make the adjusting entry here, which is debit insurance expense, and the credit is prepaid insurance. This is mainly for the amount of insurance that the company used during the first year. And remember that when the company purchased the insurance policy, which mainly on 1st of January, so the entry here was as follow. So this is not required, but mainly for clarification. On January 1st of January, so the adjusting entry, sorry, the initial entry that the company record to recognize the payment of the insurance, it was prepaid insurance, and this debit, and the credit was the cash, as this is merely for the full amount that the company paid, and the full amount here is 2050. So, and when the company uses the insurance, it's mainly covering 5 years. So we will mainly do the adjusting entry at the end of the first year, which is mainly debit insurance expense with 410, and the credit prepaid insurance. We'll move now to question number 5. So question 5 is about under the alternative method for recording prepaid expenses, what is the correct set of journal entries? So we have for prepaid expenses, we have the main method that we used so far, and we have an alternative method to record the prepaid expenses, and both methods will give us the same result. So if we look at the main method to record the prepaid expenses that we already used, so at the date of payment, at the payment date, when the company pay the expenses, so for example prepaid insurance, so we'll record here prepaid expense. So the debit side is prepaid expenses, like insurance, for example. And the credit side is cash. So this merely adds the date of payment. So when we come to the end of the year, we merely make the adjusting entry. So this merely at year end, we record the adjusting entry, and the adjusting entry here, so the debit side will be insurance expense, for example. So we'll have the expense, which is for example insurance expense, and the credit side is the prepaid insurance or prepaid expense. So this is mainly the first method. This first method, this is the one that we already used so far. the alternative method or the second method, so the alternative method, we mainly starting here with recognizing all the amounts that the company paid as expenses. So this is mainly here we have the debit side is expense, or for example here insurance expense, and the credit is cash. So what we record here for in the first entry in both methods, so it is mainly for full amount. In the first method, what we record in the adjusting entry at the end of the year is mainly the amount used of these expenses in both sides, the debit and the credit. So for alternative method also, we still in the first entry we record the full amount, and at the end of the year when we do the adjusting entry, we started here with recording the expense. So at the end of the year we reduce the expense because not all the insurance is mainly expired, so part of it expired and part is still will be used in the future. So in this case, when we do the adjusting entry, so we'll have the debit side is prepaid insurance and the credit side is the insurance expense. Which is mainly here we at the end of the year we recognize the unused part of the insurance, which is mainly unexpired insurance. Okay, because at the beginning, as the initially we recorded here the full amount as used, so which means all the amount will be recognized as insurance expense, but at the end of the year we're reducing the insurance expense with the amount that is still unexpired or unused. This will be used in the future. So if we see the alternative that we have in question 5, so you will see the answer here will be A. So the answer is A. We have insurance expense, which is debit, and the credit is cash, and at the end of the year we're reducing the insurance expense and recognizing the part that is unused from the insurance, which is mainly as prepaid insurance. So the answer here is A. So we're still with the prepaid expenses. We have question number 6. This is also for prepaid expenses, and the case here is about equipment. So we have on January 1st, Alco company purchased manufacturing equipment costing 95,000, and that is expected to have a 5-year life and an estimated salvage value of 5,000. Also, Alco use a straight line method to allocate the cost, and we need to work out the adjusting entry. And remember here, when we work out the depreciation, we mainly use the straight line method. Okay, and this is mainly the method that we have in this course. So when we use the straight line method, we need the cost, and the cost here is 95,000. So this is the cost, and then exclude from the cost the salvage value. The salvage value is 5,000. Okay, and over divided by the useful life, and useful life here is 5 years. So this will give us the depreciation expense for the first year, or the annual depreciation generally. So it is 18,000. So we record this entry, this adjusting, this depreciation expense as adjusting entry here. So we have debit side is depreciation expense, and the credit is accumulated depreciation. And this mainly for the amount of depreciation expense that we just calculated, which is 18,000. We still have one more question for prepaid expenses, and this question is question 23. And this is mainly also about the cash basis and accrual basis. So we have the first column here is about cash accrual basis and the impact on balance sheet, and second column also cash basis and the impact on balance sheet. Okay, and the third column is about accrual basis and the impact on the income statement, and the fourth column is cash basis and the impact on the income statement. So we have different dates. So this is mainly balance sheet, and we have the dates, and we have accrual basis, and cash basis, and also we have the dates again, and we have accrual basis, and the cash basis, and this is mainly under the income statement. So if we started with, we have on October 1st, 2013, a company made 14,400. So if the company use cash basis, so the full amount, which is 14,400, will be recognized as expenses. So it will affect the income statement here. So this is the income statement. So the full amount is in the income statement as expenses. And with this means that there will not be any assets here or no other expenses in subsequent years. Okay, so this is merely an easy way, but it is not recognizing the actual use of the insurance. So the insurance here is merely covering 3 years. So the insurance here is merely paid for 36 months. So if we use the accrual basis, so what we need to do, so we have the 14,400. So the first year, this is mainly benefit from the insurance here from October 1st up to the end of the year, which is December 31st. So for the first year, so the insurance used is mainly 14,400, which is mainly covering 36 months, multiplied by from October to the end of the year December. So October, November, December. So these 3 months, 3 over 36. So this mainly for the first year. This will be recognized as expenses. So it's 1,200, and the remaining amount will be recognized as assets in the balance sheet. So this mainly as the same again. This is accrual basis, but under balance sheet, the remaining amount will be the difference here between 14,400 and take away the amount used, which is 1,200. Which is merely affecting the income statement. So this amount will be under assets here. Which is 13,200. Then in 2014, this will benefit from a whole year. So this is a whole year, so which is 14,400 multiplied by 1/3, which is because there are 3 years. So this merely a third of this amount will be used in the second year, 14,400/3. So which is 4,800. So, and this also will reduce the amount recognized in the balance sheet. So in the balance sheet, the balance that we have in the previous year, it is 13,200, and the use in the second year is 4,800. So this will we will have the difference here as unused insurance, which is 8,400. And in the third year also, it is benefit from the insurance for a whole year, which is 14,400 times by 1/3. So this again 4,800. And in the balance sheet also will have 8,400, the remaining balance, minus the insurance expense in the third year, which is 4,800. So we still have unused insurance, 3,600, and this will be used in the final year. Okay, so this will be the full amount, and this full amount is mainly covering the remaining months here, which is 9 months. So if you work out this amount here is 14,400 times by 9/36. Okay, so this will give us the 3,600. So, and the balance here for the assets in the balance sheet will be 0, which is 3,600, which is the balance before the fourth year use of the insurance, minus the insurance used in the fourth year, which is 3,600. So the balance here will be 0. And this is mainly the solution to